Rising food and energy prices have put household budgets under pressure, and it looks set to get worse. According to the Monetary Authority of Singapore, core inflation is projected to pick up sharply in the coming months and average 2.5 to 3.5% for the year. It should then come down in late 2022. Now, the latest figures in March saw inflation hitting a 10-year high of 2.9%. OCBC Chief Economist Selena Ling tells The Big Story, despite rising prices, the Singapore economy remains on track to grow by 3 to 5% this year.
I think the 3 to 5% growth forecast actually remains intact. We actually shaded down our 4% growth to around 3.5%, mainly because of the start of the Russian-Ukraine war, and also because we're starting to see a lot of the global supply chains impact due to the China lockdown because of their zero COVID strategy. But that said, on the flip side, we are starting to see a bit of a silver lining in terms of the recent relaxation for a lot of the COVID-related restrictions and also the border controls. So I do expect that growth is going to be more broad-based going ahead. So while manufacturing and electronics may see slightly more modest growth compared to the high base last year, nevertheless, the services side, I think, should actually compensate a little bit. So I do expect that the aviation and also the hospitality and services sectors will play a bigger role in terms of lifting the momentum into the second half of this year. As far as inflation is concerned, I think we are starting to see very persistent commodity and food price inflation, but on top of that, domestic cost pressures continue to ratchet higher. So one thing we have to be fairly watchful for is that the labour market remains very tight, and that would translate, I think, into higher wage expectations. So there could be a little bit of that wage price spiral. If it doesn't subside towards the end of this year, then of course that could open the door for MAS to tighten monetary policy again at the scheduled October meeting.